Hello friends, welcome to my channel. Today we will understand about what is the difference between buying low and averaging with a live trading example. So buying low basically means entering into a trade after the price falls temporarily within a valid uptrend and then shows confirmation of continuation. While averaging down means adding more quantity to an existing losing position to reduce average buying price, often without confirmation that the price will reverse. So in buying low, we buy the strength at discount, while averaging the buying the weakness, hoping for the reversal. So let's take a trade, then we'll decide whether we need to average it down. We enter with 20 lots for the upside. So as you can see, I have entered long with 20 lots, and in 1 hour time frame, as you can see, the past since last few days, the BTC USD was continuously coming down, and after 20th, it has started reversing and it's trying to go towards upside. No trader knows beforehand whether it's a pullback or a reversal. So after seeing obvious signals, he decides whether to add to their position or not. Aim here is to look for signals for obvious pullbacks. If it is not, then we will average down. So the concept here is to learn how averaging down impacts the portfolio or impacts your trade, and how a lot of traders blow their account just because they do averaging. But market has to give a chance to show you averaging. So as you can see in point number 1, buying low is a process where a stock is in continuous uptrend, and after some time it gives some little pullback, and here we enter into our trade and we expect that the trade will go in its original direction. So basically we buy after a confirmation while we are buying low. So for that we see obvious support and resistance levels or any indicator confirmation like pivot point confirmation or moving averages, Bollinger bands or SuperTrend. Many people follow different kinds of confirmations. A lot of people also follow Fibonacci series. They also see candlestick patterns like spinning top or bottom or hammer, evening star, morning star, etc. Okay, so as you can see, the market has reversed and we have entered with another set of 20 lots. So as you can see, it is breaking the obvious levels. For example, 77,600 level was broken with a huge bearish candle. The market broke the level like a house of cards. Then the next support was at 77,500 levels. Again, it broke the level with another big candle. So it is an obvious sign that market is not respecting the lower levels. Market is showing obvious signals of reversal. And this is not a pullback. This is a reversal. At least I would say this is the initial signs that the market is trying to reverse. So what we try to do here is we will enter with some more lots, another set of 20 lots basically, to average it down in a hope that the market will reverse and it will go in the original direction. Let's see what happens. As a trader, we need to identify the obvious subtle signals for the trend continuation. So the averaging down is basically entering into a trade against its original trend. Here also we buy at lower levels, but we don't see for any confirmation. We blindly buy even if there are obvious signals that the trend is getting reversed. But we stick to the same trade due to many factors like ego factor or fear of losing money, or we just hope that the trend will reverse after a certain point. So here we take the trades based on assumptions and not on facts. Okay, I have put a buy limit order at the level of 77,300. So the market has to touch these levels so that I can show you how averaging kills your account. The buyers are completely failing. The bulls are not able to hold different support levels. Bitcoin is complete downtrend, but we will buy next at lower levels. Okay, unfortunately the limit order was not hit and market reversed from just before where our limit order was set. So now we will not aim for we will not aim to earn profit from this. Let's see if market gives us another chance for our limit order to be taken. Yeah, we have entered with another set of 20 lots. So as you can see, guys, averaging down is not making any sense. It is killing your account, and we have support levels, but the market is not respecting at all. So now we will not aim to earn profit from this trade. Rather, we would try to get out of this trade cost to cost. Let's see if we can do that, or we are ending up in, or we will end up in loss. So do you see, guys, how these levels are continuously being broken with big fat bearish bars? So this is obvious. These are obvious signals that the market is in downtrend, not respecting any levels. So if we hope that the market will reverse from here and it will give us profit in our trade, then we are going to lose money. Then we will lose huge amount of money. I've entered with another set of 20 lots at 77,200 levels. Let's see if the market reverses from here. This is exactly how you should not trade. This is an equation to disaster. We are entering in a hope that market will go up from here, and market is not giving any signs of reversal. So our primary aim here would be to get out of this trade cost to cost and not earn any money out of it. Let's see if the market gives us a chance to do that. Yeah, when the market would touch 77,450 levels, not even 450, you can see the pivot point in between 77,422. I would try to book my profit, because we have come into profit overall, and as we were discussing, we will get out of this trade cost to cost. So market has given a chance to get out cost to cost, and we should not miss this chance. So every trader should remember one thing: if you are going wrong and market gives you a chance to get out, do not lose that chance, and do not be greedy to make profit out of your trade, because most of the time when we try to do that, we end up in loss. So we'll close our trade. And yeah, we have closed our position with 4,741 USD. So there is a big chance that market will not go upward from here. Rather, it will go down, because the original trend, which was intact, now has changed, and market has given us sufficient signs of reversal, and most likely the market will take a downtrend from this point onwards. And that's what exactly happening. Market is going down from this point, and that's how the trap happens. If we had not exited from our trade, then we would have lost our last chance to get out of this trade cost to cost. So this is a very good example of what is a pullback and what is averaging, and how we would know in a real market, real time, to get out of your wrong trade when the chance comes. If you fail to do so, you'd end up losing huge amount of money. So a novice trader tries to average it down in hope that market will take U-turn in his direction. But an experienced trader looks for subtle signals for his trade getting failed and gets out immediately for his next trade.